Good morning, everyone. This week we are going to have this session as a pre-recorded session. So I hope you will log into the portal in the normal time and you will go through this chapter that we are going to do today. So today we are going to learn, go through a chapter which is on sole proprietorship. So as you know, our focus in this subject matter is to look at the various type of customers who will come for various credit proposals or credit appraisals that are need to be evaluated by you all. So one of the business kinds is the sole proprietorship. So we are going to look at how the sole proprietorship financial statements might look like, and what are the important areas that you need to focus on, and how to prepare a financial statements for the sole proprietorship, and what are the key elements in those financial statements. So to start with, let us look at what the sole proprietorship is, and what are the important areas that is covered under this topic. So non-manufacturing entities are trading entities which are engaged in the purchase and sale of goods at profit without changing the form of the goods. So we have been looking at various kinds of business entities, and among those we looked at manufacturing entities and non-manufacturing entities. So manufacturing entities are where an entity would manufacture the products that it intends to sell, and within its warehouse it will produce those goods using the raw material and then make them available for public to consume those. And in addition to that, they will also trade them in other markets, like exporting them to various markets, exporting it to various countries where there is a demand for the product. But here what we are looking at is the non-manufacturing entities, which means they are not going to produce the goods, but their main objective would be where they will purchase the goods from another entity and sell them in their showrooms or maybe in their shops or in their company with the objective to make a profit. So what will happen here is these type of organizations are known as trading entities because they are involved into the trading of goods that they intend to sell. And also you have to be mindful that they are not going to change the form of the goods, which means, for example, I would say, let's assume that you are going to sell milk powder packets. So I will take one particular brand. Let's say you are trying to sell Anchor milk powder packets in your grocery or in your shop. So what we will do is you will buy it from another entity who is in the business of selling Anchor milk powder packets at wholesale price, and you will sell them in your shop or maybe in the grocery at retail price level to the consumers. So by doing that, you will not go and change the form of the goods. How it was packeted, everything will look like same when you sell the goods to the end consumer. So as a result, you are not going to change the form of the good, how it was manufactured and produced and sold. You will take it as it is and sell it to another party. By doing this, you are trying to ensure that you earn a profit because these are profit-making entities. So as a result, their motive is to look at making a profit. So non-manufacturing entities, as a result, we can say that they do not process the goods purchased and sell them in its original form. So what do? They buy it like off the shelf and they bring it to their showroom or to the grocery and sell it in the same original form. So sole proprietorship is a form of business where the owner is actually the business. So we have learned this earlier under business entities, where we said sole proprietorship is a one-man show where the business is the owner. But when it comes to financial reporting, we have to see these two as two separate entities. When I say entities, it means two different parties or bodies, where the owner and the entity has to be seen separately, or the owner and the business have to be seen separately. So the diagram here tries to explain who is a sole proprietor and how he gets involved with the business. So the sole proprietor or the owner is going to generate a capital investment where he is going to infuse money to set up a new business. Now this new business is going to be called as the sole proprietorship. So during this process, you may be liable to third parties when running the business, and there will be a personal liability for the sole proprietorships, debts and obligations. So after setting up the business, you will have your own debts and obligations where you need to meet as a sole proprietor to third parties. And also the third parties also might in times make use of their money or funds to infuse into your business by way of a borrowing, where you will go and borrow from third party. So basically we call these as debts to the business. For the sole proprietorship business, it will be a debt to the third party. What are the advantages? When we look at these advantages, it is very easy to set up. Today, you decide that you are going to start up a new business. The thought that you are making is actually cost-free, because it's just your idea which you are going to put in action. And as a result, the formation of the company or the entity, or in other words, the cost related to the formation of the company is also very low. We can't say there is no cost, but the cost of forming the company or the entity will be very low. And this can be seen as an advantage compared to any other businesses, like the partnerships, or maybe the limited liability companies, or the public quoted companies. All those are a costly affair. In order to form the company, you have to go through a long procedure. There is a formal procedure, and also the cost related to forming this company also will be very high. But in the case of a sole proprietorship, it's very easy for you to understand that it is your idea or your thought that is going to get converted into a business. So it's like very free cost affair. The owner's right to make all management decisions concerning the business is seen as one of the biggest advantages, because it's your business. You are the one who is going to make the decision, and you will decide what is good for your business. But if you take a simple example such as the partnership, then you know that the partners involved in the business have to make a collective decision. So the opinions may differ. There will be conflicts among partners. So the decision making becomes much more complicated. And when you go on to bigger businesses like public quoted companies and private limited companies, there the business will be handled by a board of directors, a group of board of directors. And the decisions are to be made by those team of board of directors. So for example, if a company runs with a board of directors of 12 people, you have to have a view of the cross section of 12 individuals. And then only you can make a final decision for your business. Whereas in the sole proprietorship, it's very easy for you to make all management decisions. The sole proprietor owns all of the business and has the right to receive all of the business's profits. So here comes the owner versus the business. You are the owner, you are the business. But what is important is you will make the decisions for your business, and because of that you might end up making profits, and that profits belongs to you. So the sole proprietor owns all of the business and has the right to receive all of the business profits. But we will handle it in a different way when it comes to the financial reporting part of the sole proprietorship. A sole proprietorship can be easily transferred or sold if and when the owner desires to do so. So let us say that you are running a business and all of a sudden you have another bright idea of setting up another different kind of a business. So as a result, you want to get rid of the existing business that you are doing. So it will be very easy for you to make a decision whether I can give this easily to another person or should I just close down the business. Because it is you who is going to make that decision. And also the formalities behind transferring the business is also very simple. As a result, the proprietorship or the sole proprietorship can be easily transferred to another person or could be sold to another person. And also, if you decide, you can easily close down the business as well. When you look at the disadvantages, the sole proprietor's access to capital is limited to personal funds plus any loans he or she can obtain. Now, you know the business idea that came to you is your thought. So in order to put your thought into action, you wanted certain amount of capital. This capital has to be introduced by yourself, which means the sole proprietor. If you don't have capital, then what does it mean? You have to go and obtain a loan from a bank or any other financial provider, service provider, or the financing authority, where with that funds that you have received, you have to set up your own business. So it might be very difficult for you to find the required funds to set up the business. First, if you don't have the required funds within you, then you have to go in search of funds from other people. So it could be the bank, or it could be your parents, or it could be your friends. So access to the capital to set up the business is very limited. Secondly, the sole proprietor is legally responsible for the business's contracts and the torts committed by the proprietor and his or her employees in the course of employment. Excuse. So the sole proprietor is legally responsible for the businesses or the business contracts that he is going to handle. Now, even though the contracts will go in the name of the proprietor or the proprietorship, this sole proprietor will be responsible for any misagreements on the contract. And also, if there is a tort committed by the proprietor, or there could be people who have been employed by the sole proprietor to run the business. Say, for example, in a grocery, you will have 2-3 people to support you to run the business. So there could be a situation where your subordinates might commit a fraud or a tort. So in such instances, the result of that, or for the result of that, you are legally responsible because you only have deployed those employees in your business. Now let's look at the financial statements of a sole proprietorship. So basically, the financial statements of a sole proprietorship focuses about the performance of the enterprise, and it is judged on the basis of income earned, accrued during the year. So I don't need to go back and teach you all this concept of accrual concept because we have already learned those. So all the accrual, all the concepts, principles, assumptions that we have already learned are applicable even for a sole proprietorship. The profits of the business are measured at 2 different levels. Now, this is where the businesses or every kind of business might differ from one another. When it comes to a trading business, the profits are measured at 2 levels. Later on, when we go on, you will see the financial statement of a bank might not have this kind of a profit estimation at 2 levels. But when it comes to a sole proprietorship, the profit is measured at 2 levels, namely at gross profit level and also at net profit level. So it is very important that you know how to calculate the gross profit and the net profit of a business concern, especially in the case of a trading business. The financial position of the business enterprise is judged by measuring the assets, liabilities, and capital. So the term financial position here, you have to be mindful that they talk about the balance sheet of the business enterprise. So you will have a balance sheet for the sole proprietorship, and that balance sheet is going to be judged by measuring the assets, liabilities, and capital of the business. So let's look at the income statement of a sole proprietorship. The income statement is divided into 2 parts, namely the trading account and the profit and loss account. So we will learn in detail what is this trading account is and also the profit and loss account is. In order to determine the net profit, the gross profit has to be calculated first. So the initial part of your profitability is the gross profit that you have made in the business. What is gross profit? Gross profit is the difference between sales, and we introduce another term which is known as cost of sales. So sales, all of you know, we have already learned the books of prime entry. So sales means the amount that you have already sold from your business. It could be on cash basis or it could be on credit basis. It doesn't matter. Now, what is cost of sales is what have you incurred? Again, I will repeat that. What have you incurred? It's not what you have expensed, what you have incurred to make these goods that you are selling. That you are selling. So sales and cost of sales are interconnected. Interconnected. So you need to know that the amount of sales that you are making, say for example, you are selling 100 units. So your sales actually will be 100 units into the selling price per unit. Now, what is cost of sales? Cost of sales will be the cost involved in producing those 100 units. Those 100 units. The trading account, as I told you earlier, the income statement or the P&L of the sole proprietorship will have two sections, namely the trading account and the profit or loss account. So the trading account will look like this. Trading account will look like this. So you have total sales, then you deduct the sales return, then you will have the net sales. Once you have reached the net sales, then you have to work on how to calculate the cost of sales. Cost of sales. So cost of sales will be your opening stock, what you have purchased during the year, what you have returned from the purchases that you have made, and take out the amount of closing stock that you are holding, which will give you the cost of sales, the cost of sales of the business. So the sales minus cost of sales gives you the gross profit. Gives you the gross profit. Now, what is the difference from trading account to the profit or loss account? Now, the profit or loss account is supposed to commence from the gross profit that you have made. So, in order to calculate your net profit, the starting point will be your gross profit. How did we arrive at the gross profit? This is how we have arrived at the gross profit. Okay. Now, when you look at the profit or loss of account of the sole proprietorship, which is to calculate the net profit, your starting point is going to be the gross profit. Then you will add all the other income that you may have received in the business. Okay. So that is like if you have an investment, you might have received some income from the investment. Or if you had some fixed assets or something like any other assets that you might have sold, you will have an income. So to the gross profit, which is mainly focusing on the stocks that you have sold, you can add all the other income to formulate the total income. Then from the total income, you will take out all the related expenses. All the related expenses. What are these expenses? You will take out all administrative expenses. All administrative expenses. Then you will have the selling and distribution expenses. Selling and distribution expenses. And also you will have the financing expenses. Financing expenses. So altogether, you have three types of expenses that are covered under the profit or loss account. Profit or loss account. So let me show you on the board how this works. Okay. So we have the income statement. So the income statement has two parts. One is the trading account and the P&L account. Okay. So trading account is looking at your sales. P&L account is actually looking at your net profit. Your net profit. So the trading account, the ultimate result of the trading account is the gross profit or the loss. So I am putting the loss in brackets, which means it is a negative. The P&L account will result in, the ultimate result is to have a net profit or a net loss. Net loss. So the link between these two, how it is getting connected is, you will bring in all the other income of the business and that is added, and you will deduct all the overheads. Overheads means expenses. So this is how the net profit of the business will be calculated. So the net profit of the business will be calculated at two levels, namely first at the trading account level, which is to calculate the gross profit or the loss. It could be a loss also. Secondly, to calculate the profit or loss of your business, which is to look at what is the net profit or loss of the business. So in order to calculate the gross profit or the loss, we have to consider the sales and then the cost of sales. So the gross profit or loss is the result of sales minus cost of sales. Cost of sales. Then when it comes to calculating the net profit or loss will be, basically, you will start with the gross profit or loss that you have made from your core business, that is selling goods. And to that, you will add all the other income items, whatever that you may have in your business. And then you have to take out all the expenses, which we call it as overheads. Overheads. The terms that we use are very important. In case if you have a term like overheads in your exam paper, which means that is all the expenses that you have incurred. Now the expenses that we are talking about is other than the cost of sales. It is not going to get duplicated, right? So overheads means all the other expenses that you have incurred other than the cost of sales. Other than the cost of sales. Now what do we have in this other overheads? Other overheads. So let's go back to this. So what do we have here? Firstly, the administrative expenses. So your overheads has different items that are covered Among those, one such item will be the administrative expenses. The administrative expenses. Now, what are these? In order to run your business, you will have certain administrative expenses, and those are the salaries paid to your staff. Salaries paid to your staff. Rent and rates. Rent and rates. Heating and lighting. Heating and lighting means all the electricity that you are going to use, all those will be included in that. Then you have telephone charges, postages and stamps, legal and other expenses. So you will have various kinds of expenses which are all of administrative nature, which are all relating to administrative nature of the business. Administrative nature of the business. Then secondly, we have the selling and distribution expenses. Selling and distribution expenses. Now, what are these? We know that you are doing or running a trading business. So, what is your trading business means? You are going to sell goods to people or to the consumers. So, the goods that you are going to sell actually could be sold at your grocery or at your showrooms that you have, right? So in such instances, what will happen is sometimes you might have to incur certain expenses for the purpose of selling your products. For example, you might have to promote your products to make it more attractive. To make it more attractive. Now you will see that even in the banks, your products, to make it more attractive, you all go and do a lot of advertising in the television, in the radios, and even on the web, and even in the social media. You will do a lot of advertising or promotional activities. Now all these are relating to the selling of your product. Selling of your product. But what happens in a trading business, they may have to incur certain expenses which are directly related to selling of the products. Selling of the products. So those type of expenses are considered to be selling and distribution. Selling and distribution. So what are the few items? Salesman salaries and commission. So you know these trading businesses, what happens? There will be a salesperson who will be selling these products, or they will go to each door, that is each house, and they might go and sell the products to their doorstep. So the person who is selling those products sometimes might be have to be paid salaries, and also they might attract certain commission. Certain commissions. So that is when you have an employed person, and that employed person is doing or looking after the sales of your company. Okay. Sometimes what we do is we recruit people from outside. We call them as outsourcing of your business services. So when you outsource services, what will happen? You have to pay for the people who have been outsourced to sell your products, and that payment you make to those people are called commission to agents. They become your agents to the business, and to those agents you pay a commission. You pay a commission. Then you also have advertising. As I told you, the advertising part of expense is also there. Then you have packing expenses. Sometimes what happens, you bring in the raw product. You bring in the raw product from the wholesaler, and then you have to do some repackaging. You have to do some repackaging. This repackaging happens to promote your name in the product. Or sometimes you buy the raw product and you do the packaging so that it is less cost to you. The packaged product might be more expensive, but when you buy the raw product and you do the packaging, sometimes it will be less cost to you. So you would prefer that also. Any expenses that you incur for packing is also selling and distribution. Then the next item is export duties. Export duties. Now, what do you mean by export duties? Assuming that your business is going to export these items to foreign markets or to different countries, then these export items will attract certain amount of duty. Duty means taxes. So you will have to pay these taxes in order to export these goods. Now sometimes even when you import goods, you have to pay taxes. You have to pay taxes to the clearing agents and also to the customs. You might have to pay taxes to clear the goods. That is for imports. Now here you are running a trading business, and part of your trading business includes exports. So what you have to do is, for the exports part of it, you have to pay taxes. Then sometimes what happens, you might have vehicles which are used in the distribution of your goods. Now I can think of an example. Let's say, assume the company Damro as a trading business. Of course, it is not a sole proprietorship, but assume that it is a trading business. Yes. Now, what do? You go to their showroom and look for the item, and you choose one, pay for it, and they promise to deliver it to your doorstep. So they come in their lorry or maybe the high roof vans, and they bring the product to your doorstep. Now, these vehicles that they come are owned by the company itself. So they make use of these vehicles for the purpose of delivering goods. So you go to the doorstep of each and every people and you deliver these goods. Now these vehicles have to be maintained. You have to put fuel, you have to service them from time to time. So you might incur various expenses in relation to the maintenance of these vehicles. So in order to maintain these vehicles, the expenses that you may incur are also your selling and distribution expense. Then also you will have insurance. Insurance is one of the important part of this business concern. Why? You might have lot of products being stored in your showroom or maybe in your shop. Now you have to protect these products at all times, because there could be floods, there could be fire, there could be a natural disaster. So anything can happen to your business and as well as to the products due to these natural disasters, or even for man-made disasters. So in order to get protection, what you have to do is you have to get all the products as well as your shop insured. You might have to incur large costs to insure your products. And that also becomes part and parcel of your selling and distribution expenses. And finally, most important item in the selling and distribution side is the bad debts. Now, bad debts, of course, we don't call it as an expense, but in theory, we put it under selling and distribution because that is just to capture the defects of your sales. So let me try to explain it, what these bad debts is. So you know now when you do sales, sales can take two forms. One is cash, the other is credit. Okay. So cash sales, very straightforward. You will debit cash account, and credit sales account. Very straightforward. But when you do business or sales on credit basis, again you will debit debtors and credit sales. So which means now you have sold your goods and you have given a credit period. So let's assume on average you give a credit period of 60 days. So when you have given a credit period of 60 days means from the date of the sale, your debtor or the person who has bought goods have 60 days to repay you. Has 60 days to repay you. Now within these 60 days, anything can happen. Sorry. Anything can happen. Say for example, you have sold goods to one person on credit basis and you have given a credit period of 60 days. Credit period of 60 days. In about 30 days time, let's assume the person to whom you have sold the goods has passed away. He has met with an accident and he has passed away. Now, what is going to happen? The amount of sales that you have made to this particular person. Because you have credited sales, but you are holding that amount of sales that you have done on to this person under debtors. It is not cash, still it is in debtors. Now this amount that you have put in debtors was lying for about 30 days and you have given a credit period of 60 days. So you can think that within another 30 days this customer would pay, but apparently on the 31st day this customer has passed away. And now you know that this money that was pertaining to you to be paid by the debtor is not going to be paid. Not going to be paid. We take the scenario that this customer or the debtor is not going to pay you, or his heirs, maybe his wife or whoever, we assume that they are not going to pay you because they don't have any other source of income. So with the death of this person, you are not going to get the money. Now that is a loss to you. That is a loss to you. That loss in these type of businesses is known as bad debts. Bad debts. So it's very important you know that what is bad debt is. Any debt that you are not in a position to recover, any debt that you are not in a position to recover is known as a bad debt. Now this is what we call in banks as non-performing. So I don't want to explain what is non-performing at this point in time, because later on we will have a topic to discuss about non-performing. So for a trading business concern, instead of non-performing term that we use in banks, here we use as the bad debts. The bad debts. So what do you mean by bad debts is, bad debts is the debts or the amount of debtors that you will not be able to recover. That you will not be able to recover. So what do we do? If that is the case, we will debit the bad debts account and credit the debtors account. You will debit the bad debts account and credit the debtors account. And be mindful, this is a P&L account. P&L. So that is the account that we have been talking. Under selling and distribution, now this bad debts account will appear because it is not really an expense, but it is a loss to you. It is a loss to you, where this customer or the debtor is not going to pay you. Not going to pay you. So as a result, your bad debts are going to become a loss to your business. And you have to recognize that loss in the business in the form of a selling and distribution expense. Selling and distribution expense. Okay. So I will give you about 2 minutes to take down this on what is there on the board. So make use of the time and take down. So this is one scenario where you will recognize the loss pertaining to the bad debt into your P&L. Now there is another scenario where, let me give you an example again. Let's assume you have sold goods to a person. You have sold goods to a person and you have given a credit period of 60 days. You have given a credit period of 60 days. So sold goods and you have given a credit period of 60 days. So you are expecting, let's say, rupees 100,000 to be paid by a debtor. So what you would have done? You would have debited debtors 100,000 and credited sales 100,000. Okay. So after about 45 days, 45 days, this debtor comes to you and tells, look, I bought goods from you for 100,000, but at this time I am facing some difficulties. So let's say with this COVID-19, he is going to face certain difficulties. And as a result, he says that he is unable to pay this 100,000. But instead, I will pay you 25,000. 25,000. And let me have few more time to pay you the balance 75,000. So looking at the condition, now it's COVID-19, so you know that people are facing difficulties, and you, since you are also into a business and you consider it favorably, and you say that, okay, I will accept this 25,000 and I'll give you another 60 days from this date to repay the balance 75. So your debtor goes happily, but you get to know this person is really struggling with his business. So now there is a bit of doubt in your mind that whether you will get this balance 75,000. Okay, slightly doubtful. So it is not yet materialized as a loss. It is not yet materialized as a loss, but you have a doubt. You have a doubt whether this person will pay this 75,000 even after giving 60 days. Okay. Now you wait for the 60 days. Money doesn't come. You give a call to the debtor. He doesn't answer the phone. You go to his place. His shop is closed. You go to his home. He is not to be seen. So now you are finding some problems in getting this 75,000. So now 75,000 is actually very much doubtful. So according to the accounting terms, when you foresee a loss or a debt turning into doubtful, you have to make certain provisions in your books. We call it as provisions. And this type of provision is called a bad debt provision. Bad debt provision. So you have to assume that, okay, I have another 75,000 to be collected. So now I have to start making provisions. So you will make a provision by debiting bad and doubtful debts account and credit provision for doubtful debts. So you need not provide 75,000 immediately. I can start with 10,000. Okay. In a month's time, I will increase it to 20. If the customer still doesn't pay, 30, 40, likewise, you have to start making provisions up to 75,000. In case in between, if the customer comes and pays you something, you discount that and reduce your provision. So what are we trying to say here? Earlier, when you know that it is going to be a loss, you debited your bad debts and credited your debtors because you are not going to get it back again. Now, in this scenario, it is not the case where you are going to turn into a loss. It might turn into a loss later, but currently it is little bit of doubtful. So as a result, you are going to make a provision for bad and doubtful debts. So the provision that we are making here is to debit the bad debts account and to credit the provision for bad and doubtful debts account. So the debit bad and doubtful debts account is your P&L, which is shown in the selling and distribution account, and the credit provision for bad and doubtful debts is your balance sheet account. balance sheet account. So we call that as a balance sheet. So take about 2 minutes to take down this. Okay. So let's get back to the presentation. So this is on again the items that are appearing on selling and distribution. So you know how each of these items will appear in your financial statement. Okay. So let's now get on to the next financial statement, which is the balance sheet of a sole proprietorship. Which is the balance sheet of a sole proprietorship. So if you look at the balance sheet, now I have given this as a fully comprehensive balance sheet. But depending on the question, sometimes you might not see all the items appearing in the balance sheet. Okay. So what I have given is somewhat a fully comprehensive balance sheet of a sole trader, sole proprietorship, where depending on your question, some of these items might not appear, or depending on the customer, some of these items might not appear in your customer's financial statements. Okay. So what do we have here? The first item we have is called the tangible fixed assets. Tangible fixed assets. What do you mean by tangible fixed assets? The fixed assets which can be touched and felt. Touched and felt. Secondly, we have the intangibles, where you can't touch and feel. Where you can't touch and feel. So look at the items that are appearing there. Goodwill. So goodwill is the good name that you have for the business. Or in other words, you call it as the brand name. The brand name. Say for example, Singer. Now the Singer brand has a brand value. Singer brand has a brand value. And how it depends? How much popular it is among public. How much popular it is among public. Whether when you say Singer, people whether they recognize the product. Whether they recognize the product. So it is the brand name that we are talking about, the goodwill. The goodwill cannot be touched and felt. So it is something an intangible. An intangible. Then you have investments. Investments. So which are of long-term nature. Long-term nature. Then you will have the current assets. The current assets. so which we will learn in detail when we go to LKS 1. Then we also have certain items appearing under current assets like inventory in trade, that is the stocks, trade receivables, that is your debtors, prepayments, those are any advance payments that you have done, bank balances, that is your cash book, bank column, and also cash in hand. Cash in hand means the amount of cash that you have in your hand or in your vault with you. And that comprises the total assets of your business's balance sheet. Business's balance sheet. So total assets will be these items. These items will be the total assets of your business. Then we go look at what are the capital items and liabilities. Capital items and the liabilities. So when on the capital items, you will see there will be your capital and then you have the profit. Now from where this profit is coming? From your profit and loss account. Profit and loss account. So the amount that you have generated as profit or a loss, the net profit or a loss, that will come here as part of your capital, which we have already learned under the accounting equation. Then also you have the drawings. So I don't need to explain the term drawings now because you already know drawing is the negative aspect of the capital. How much the money has been or goods that has been taken by the the business owner or the sole proprietor. Then you have all the long-term liabilities and the current liabilities and at the bottom of the right side, you will see certain items as provision. So what is the first item? Can you see that? That is called provision for bad debts. So that is what I was explaining previously. For the doubtful bad debts, what you will do? You will make a provision. So that provision, debit goes to the P&L and the credit comes here to your balance sheet. So you will see, now you know where this provision for bad and doubtful debts appearing. Where it is appearing? It is appearing under liabilities. So basically that is all about a sole proprietorship business. Now we have done this in very brief, but there could be like complicated sole proprietor businesses as well, where you are running a sole proprietorship at a large scale. But eventually those have to be converted into any other form of business, because being a sole proprietorship, you can't run that kind of a large business for administrative purposes. It might be very difficult for you to manage the affairs of the business. So basically, sole proprietorships are small nature of businesses where you can administratively handle the business. Okay, right. Now let's look at the question that I have given there. What does it say? Can you all go through the question if we do? So when you look at this question, you see from the following information, prepare a trading account. You are requested to make a trading account, okay? Of Measures ABC Traders for the year ended 31st March 2011. So what are the items that you have? Opening inventory, that is opening stock. Then you have purchases, carriage inwards, wages, sales, return inward, return outward, and closing inventory. Okay. So the question here is, you are required to do the trading account. Now, what is the result of a trading account? Trading account will give you the gross profit. Trading account will give you the gross profit. So it is not the net profit. In order to reach the net profit, you need to have the administrative expenses and the selling and distribution expenses, and also if there are any other income, you need to have that also. Okay, so you need to be mindful that when you are asked with the specific question, prepare the trading account, you need to be sure that trading account will give you only the gross profit. So the question talks about what is the gross profit. What is the gross profit? So let's do it. Right. So we need to say the company name, ABC Traders at the top. Then trading account, Then you will say for the year ended, 31st March 2000. And below that, we will do the trading account. So it is given in rupees, so we have to say rupees. So what is the structure? First you have to say sales. So what is the amount of sales? Sales is 1.1 million. 1.1 million. Then you have return inwards. Return inwards means it's like the sales return. Return inwards. So return inwards, you have 100,000. So you have to deduct that. When you deduct that, you will have 1 million as your net sales. Then you have to deduct less cost of sales. So how do you calculate the cost of sales? First you will put, so I have already given you the template. I am using the same thing. Opening inventory. Then you will add purchases. So your purchase is about 672,000. Then you deduct. What is that? Returns outwards. Return outward is purchase returns. Returns outward. So that is 72,000. Then you also have carriage inwards. That is 30,000. Then you have wages 50,000. Okay. So from this you will deduct less closing inventory. Closing inventory is basically 2 lakhs. So if you total this, it will be I think 420. So that is your total cost of sales. Am I correct? 672, 772. And when you deduct 72, it's 7. 7 to take out 2 is 5. 5 into 420 is. Then your gross profit will be 580. Gross profit will be 580. So this is how you calculate. I don't know whether the board is visible. So the total amount of 580, which is the gross profit. So how you arrive at the gross profit is, you first calculate the net sales, that is sales of 1.1 million, and a return inwards of 100,000 is there. So when you deduct that, you will have 1 million as your net sales. From these net sales, you have to take out the cost of sales. You have to take out the cost of sales. So the cost of sales will be you have to start with the opening stocks or the opening inventory, and you will add the purchases, and you will deduct the purchase returns, and you will have to, sorry, I have made a mistake. You have to add the two carriage inwards and the wages, because it is part of your cost, and then you will take out the closing inventory. So 772, it will be 7, 780 will be 580. Then your profit will be 420. Sorry about it. 420. Okay? Because carriage inwards and wages are part of your expenses, cost of sales, because you would have brought in these goods to your showroom. So that is your carriage inwards. And for the laborers, you might have paid wages. Okay? So those two will be part and parcel of your total cost of sales. Okay? So you add those and you take out the closing inventory, because you started with the amount of stock and during the year you have purchased some stock and you have returned certain, and after selling the products you remain with the 200,000, which means you can find out what is the real cost involved for the products that you have sold. So that is the objective of cost of sales. That is the objective of cost of sales, to find out what is the real cost that I have incurred to sell my products. To sell my products. Okay. So let's go back to the presentation. So this is what we have been looking at. Then you have another question where I have given you a trial balance and you are required to prepare the balance sheet. You are required to prepare the balance sheet. Now for you to prepare the balance sheet, I have given you the template, the balance sheet template. But the problem here is, when you go through the list of trial balances, okay, you have various type of items there. So you need to put these items into the right place. Right place. Okay. I have given you the template, that is tangibles, intangibles, then you have current assets, then you have the capital, and you have the profit, then you have the drawings, and you have the long-term liabilities and the current liabilities. So based on that, you need to do the balance sheet of this particular business. So can we do it? Can you give it a try? So let's see whether we can do it. Not sure whether I can use the space of the board properly due to the limitation. But let's see. Okay. If at all, I write it on two sides. Okay. So the question is, again, similar to what we learned. Okay. I'll write it from here. So it is Messrs. Dayal Brothers, then balance sheet, so balance sheet is prepared as at a particular date. This is as of 31st March 2011. Okay. So we'll try to do it on two sides, assets on one side, on the liabilities one side. So let's say first assets. But ideally speaking, you have to do one by one down the other. But I'll try to do it on this side and right and the left. Capital and liabilities. Capital and liabilities. Okay. So the first item, they say capital. So capital, you know, very straightforward. You can put it here, which is 700,000. Then you say land and buildings. Land and buildings is, you know, it is assets and it is a tangible asset. So land and buildings. So land and buildings is 300,000. Then you have a 14% term loan. Term loan means that is a long-term liability. So here we will have liabilities. Okay. And the 14% long-term loan. Okay, long-term loan. So that will be 400,000. And then you have another loan from a company, loan from D&Co. So I'm utilizing the space in the best possible way. Then you will have the current assets. I don't know whether they are intangibles. Yeah. Assets. So under current assets, you have trade receivables. Trade receivables, that is 420,000. Then cash in hand, that is 20,000. Inventories, that is 600,000. Then they say furniture. Furniture is again a tangible. Furniture, that is 200,000. Then they say trade payable. Trade payable is a liability. Trade payables is 40,000. Then advances to suppliers. Advances to suppliers. Advances to suppliers. That is 100,000. Then you have net profit of 100,000 and drawings of less drawings of 60,000. Okay, so that's it. So here we have 500,000 and here we will have 64 1.1 1 million 1140,000. So altogether my total assets will be 1640,000 total assets. On the liability side, so you have 8 minus is 740 and here 44860 900 and therefore total capital and liabilities will be same as 9 plus 740 means 1620. So you see the total assets agrees with the total capital and liabilities. Total capital and liabilities. So this is how you do a balance sheet of a sole proprietor. Sole proprietor. So because of the space only I have written it like this, but in exams actually this has to come one after the other. That is, you start with the assets and below that you will write the capital and liability. So it will be like a long financial statement will be your balance sheet. Not you don't write it on the two sides. Okay, so that is about the sole proprietorship balance sheet. So let's look at what do we have here. So I have a question from the past paper. So you will see this past paper question, of course, have a mix of some other areas that we are supposed to learn. So, but for the time being, we can look at the first part of the question. Okay. So if you look at the question, this is how it goes. They say Nelum Bank PLC is currently assessing a loan application submitted by its customer, Lotus Traders. So you see, this is what I have been talking about. Now they are saying that Nelum Bank is a bank who is currently assessing a loan application. So Lotus Traders have given a loan application for a new loan of 100,000. Answer the questions based on the following ledger accounts of Lotus Traders for the year ended as at 31st December 2016. So what has happened is, this Lotus Traders has applied for a loan, and they have given, instead of the financial statement, they have given a trial balance. And it's actually not a complete trial balance, but it is part of the account balances. So there are few items which may relate to this question, but not the entire trial balance is given. Right? Now let's look at the questions. Part 1. So there are 4 parts, which means you have 20 marks for this question, and each part will have 5 marks. Each part will have 5 marks. So this is a real exam question that came in March 2017, right? Just look at it. Part 1. Calculate net profit of Lotus Traders for the year ended 31st December 2016. Okay, so you have been already given some list of balances. Based on those balances, you are required to calculate the net profit or loss of Lotus Traders for the year ended 31/12/2016. So I taught you how to calculate the gross profit first. Now here they are talking about the net profit. So you have to start with the gross profit, that is a trading account, and then you have to go on to the net profit or loss, calculating the net profit or loss of the business. Then part 2, they say calculate 2 financial ratios that are useful for assessing the repayment capacity of Lotus Traders. So which we haven't done yet, because there is one topic that we need to cover, which is on financial ratios. So once you have done that, you can come back and look at this question to do it. Third part, what is the applicable accounting concept? They are talking about an accounting concept, which we have already learned. For accounting of payable water bills. Payable water bills. So they are talking about the accounting concept pertaining to the payables of water bills. So the payable water bills is the item which is appearing in the above list of balances. And there is an amount also given. So you need to be very careful in understanding what these payable water bills is, what type of an account it is. So depending on that, you have to say what is the applicable accounting concept. And the fourth part, they say, in terms of accounting, what is the main difference between current and long liabilities? Current and long liabilities. So current and long liabilities, the differentiation we will learn, because that is part of LKS 1. There is an accounting standard called LKS 1. So under LKS 1 only, we will learn the differentiation between current and long liabilities. Okay. So what you can do is, you can make an effort to do the part 1 and part 3 of this question. Okay. Part 1 and part 3. Leave the part 2 and part 4, because we are yet to learn those 2 areas. Once we have done, we can come back and look at this question for those 2 sections. But part 1 and part 3 can be done by you all, because part 1 relates to the calculation of the net profit of the trading business, and part 3 is something to do with the accounting concepts that we learn. So you see that all the sections that we learn in this subject module is very important, because they are interconnected. You may get one single question where it connects so many sections. Okay, so in this question you have 4 parts. Out of the 4 parts, you see 2 parts are coming from 2 different areas, and the remaining 2 parts which we are yet to learn, that is also 2 different areas. One is on financial ratios and the other one is on a standard, which is on LKS 1. So it is very important that you keep on revising all the topics that we learn, because every time when we do a new question, what we already have learned will get connected. So it is important that you do continuous revision with whatever that we learn. Okay. So I am leaving that part 1 and part 3 for you all to do at home. When we meet next time, we will go through it, because with whatever that we have learned today, you try and manage to do it, and let's see how many of you have get it right. Okay. So with that, we wind up the session for today, which is on sole proprietorship. So when we meet next time, we will start with a new topic after completing this part 1 and part 3 of this particular question. Okay. So have a pleasant weekend and have a good